Good morning, everyone, and apologies. I always apologize. I'm going to speak in English, so thank you for all that hard work you did at school and all the learning and all the textbooks. And sorry I don't speak Portuguese, so thank you for that. And it's a pleasure to be in Lisbon. I've never been here before. I must be the last person in the world who doesn't live here. Everyone I know is moving to Lisbon, so must be something extraordinary about it. So thanks very much. I'm going to talk about ESG, and I've just noticed that my title slide, which is the same slide I always use, it's actually my parents' house. It's called Fishwick House. My company is named Fishwick, and that's why I put it on the slide. But it's interesting. It's for sale, bizarrely enough, and it's also the most famous house in Australia. And the reason I'm going to talk about it for the first time for a couple of minutes is because we think sustainability is new, but actually this was an architect, very famous architect who used to work for Frank Lloyd Wright, who you may have heard of in the US. Walter Burley Griffin and his wife worked for him in Chicago, and more academics are thinking that they actually did all the work. When Frank Lloyd Wright was out sleeping with his clients' wives a lot of the time, Walter Burley Griffin and his wife, and she was the first ever female architect in the world, did all the work. So they invented open plan and organic architecture and those sorts of things. And they won the competition to design Canberra, the capital of Australia. So they left Chicago. They designed Canberra, and then they decided to build their utopian ideal suburb in Sydney. And they built a couple of houses. This was the main house. Then the Depression hit, 1930s. He went to India, he fell off a ladder, and everybody forgot about him. But Frank Lloyd Wright went on to become the most famous architect in the world. So it's a lesson for everybody, but these guys, these two architects, were really the pioneers in building from the local stone, making sure the house was incorporated into the local environment, didn't use too many materials. So it's very interesting. So I'm going to introduce myself quickly because I am not in my home country, and no one's ever really heard of anyone who's not in their actual home country. So I was actually a serious guy when I grew up. I did economics at Cambridge. I started to run global equity portfolios at Deutsche Bank. I ran the Lex column at the Financial Times. I ran research at Deutsche. I worked directly for the CEO, writing his speeches, writing his briefing notes. I then ran research on the sell side for DWS. I ran research and insights at HSBC, and then I ran responsible investing at HSBC as well, both helping the group and the asset management side. And then I went to give a speech after 15, 20 boring years doing what I did in finance and journalism and management consultancy as well at an FT conference. And I thought I made relatively boring speech. I had given the speech many times before. I basically said, for most investors, climate risk isn't as big as people worry about compared with interest rates and inflation and growth and China and wars in Russia. Yes, it was a risk, but maybe it wasn't as big as everybody thought. And if you put up a 100-year chart of the US stock market, it goes up and up and up and up and up despite wars and oil crises and all sorts of things. So don't worry about it, guys, was basically my speech. Okay, maybe I made a joke about Miami being underwater and not worrying about that because Amsterdam was underwater. And maybe I was a little rude to regulators saying, stop sending me so many forms to fill in and so much red tape. But anyway, I woke up the next morning and all hell had broken loose. I was about to fly to give another speech, and HR called me up and went, "You're not coming in today. You're not going on that trip." And I looked at the computer, and I was #1 news on the BBC, #1 news on the TV, #1 news around the world after what I had thought was a pretty dull speech. So I was suspended. And I didn't let them do that to me for very long, and I eventually resigned, and my resignation letter was read a couple of million times. And now I'm in this strange situation where I get dinner requests from women all around the world and strange nut jobs in America, and it's incredible how many crazy people there are out there when something like this happens to you. It's quite weird. But that's where we are, and today I'm back at the FT. They were kind enough to offer me a job after making me lose my other one. I give speeches and I advise CEOs as well. And I'm very big in Belgium, I have to add. That's something I've always wanted, and I can tick that box now happily. So what are we going to do today? I've got about 25 minutes to talk, maybe half an hour, and then I'm going to take questions. It's a small enough room we can be informal. I'm going to answer the questions, does ESG matter, and for whom? Does it actually solve anything? Does it help the world? Does it actually have a real impact, or is the whole thing a bunch of nonsense? And 2023, what is the right way to think about it? What is the grown-up way? If you start from first principles, if I put my analyst, management consultant hat on with a blank sheet of paper, what is the correct way? Because sustainability in ESG is pretty new. There are no rules. No one really knows the correct way to do it. And what I will argue is to say we should all approach it the proper way, from first principles, logically, as if we were intelligent human beings, instead of taking orders from people who hug trees for a living or generate lots of bureaucracy from Brussels or Frankfurt. Okay, so first question, does it matter for investors? Let's look at investors first. Now the answer is clearly yes. This is the growth in ESG equity assets over the last 8-9 years. And it was parabolic before that. But look at the numbers now. We're almost approaching $60 trillion. And you'll all know off the top of your head that the global equity market is roughly 120, 130 trillion. So we're now approaching half of all money, equity money in the world, managed to some sort of ESG criteria or ESG label. And we'll talk later that means different things to different people. But asset managers are now saying, yeah, roughly half of all equity assets are managed to ESG. So it does matter clearly for investors on the equity side. It now matters a lot to fixed income bond investors, and you will all know the incredible growth in green bonds, sustainable bonds. Any crappy company with half-assed project wants to get it away, will put a green label or a sustainable label on it, and investors are lapping it up. And you can see the growth in green bonds and sustainability bonds as even more accelerated than in equities. So on the equity side and the fixed income side, it matters to investors. Yes, tick. Now, if it matters to investors, what about asset managers? Yes, it matters. Asset managers will do anything it takes to win assets. In the dot-com boom, when I used to work, we would say everything was dot-com and e-commerce. And now, because investors care about ESG, we care about ESG as well. And most importantly, which I put in yellow, investors are willing to pay more. And a lot of you will know that fees have been coming down in the investment industry. So if there's anything we could have done when I worked in asset management to stop that from happening, we will do it. So it's no surprise that the asset management industry loves ESG. If clients are willing to pay, we will launch ESG funds. Don't you worry about that. Okay. But for investors, there is still a fundamental problem that ESG means different things to different people. When I grew up and ran money, ESG was what I call an input. The original ESG, or we called it sustainable investing, or we called it responsible investing, or social SRI, you might remember SRI. It was taking environmental, social, and governance issues and risks into account when you bought or sold assets. You took those things into consideration when you bought and sold things. That's how a lot of people today, including asset managers, still think about it. When you look at an MSCI ESG score, that is what they're talking about. Elon Musk gets his knickers in a knot when he says, my ESG score is wrong, my company is better or greener or more sustainable than another company. No. MSCI ESG score is an input score which measures the risk of ESG on an asset, which is the other definition. When most people think about ESG now, they think about it as an output. Is a company very green? Is a company got good governance? Does it have good social characteristics? It's an output. And people do not agree on which definition of ESG they are using. And this causes a huge number of problems. And I would argue now, for most mums and dads or my mother, most people now think of ESG on the right-hand side. Is the company I'm investing in a good company? Whereas a lot of us still operate on that risk side of the equation. And that has big repercussions. Sorry this looks a little bit confusing, but it's very important. Let's pretend your ESG score is on the y-axis and your valuation, how expensive a company is on the y. If I was running money thinking with my input hat on, I would never buy an expensive company that had a bad ESG score. And I would only buy a few companies if they had a good ESG score because I thought the expensive valuation was worth it. I would buy cheap companies if they had a good ESG score. But look, I would also buy a company with a low ESG score if it was in the price, if its poor ESG characteristics were already incorporated in the price. And this becomes problematic because I will sit in front of a client and they'll go, why do you own this cement company with a low ESG score? And I'll say, well, those risks are already incorporated in the price, and I think it's going to go up, and that's why I own it. And they get very, very cross because they are thinking in an ESG output world that I should never own an oil company or I should never own a cement company. And no matter how cheap it is, you should never own it. And this confusion is at the heart of the conflict between companies and investors and our ultimate clients, and it's worth thinking about a lot. So that's for investors. Now, what about companies? Does ESG matter for companies? Now, it really depends, is the honest answer. Are you public or are you private? Are you regulated by Frankfurt or by the European Union who are going to tell you what to do, no matter what? Even if you disagree with ESG and sustainability, are you going to be told? Is it something you care about as a company? Is it something that you want your reputation to be known for? Does the CEO care? Is it something that he or she wants to embody? Do you think it's going to help you recruit people? Are you in the process of raising capital? That's a very important point. Does your cash flow cover your capex, in which case you don't need to go to the market? But if you do need to go to the market and to raise equity or to raise debt, and your clients and your potential investors care, then you really must care about ESG a lot. All these things need to be taken into consideration for companies. The trouble is, but what you're being forced to do now is becoming ever more important. And last night I was talking about a number of new rules that the European Union is going to start bringing in on that are going to force quite small companies, starting with companies with 500 employees, going down to 400, going down to 300, public or private. You are going to have to start doing more and more environmental related paperwork. Just on supply chains, for example, companies as small as 500 employees are soon going to have to do detailed analysis on every single supplier that you have. That is a massive amount of work for relatively small companies, and that is coming to a lot of everyone's way in Europe. Okay, second question I promised I would answer. Does it actually solve anything? Does ESG have an actual impact or not? Let's talk about it from the investment point of view to start off with. Do investors investing with ESG actually make a difference? And here I have quite a different view to a lot of people in the market, you won't be surprised to learn. I think a big problem in this discussion is around the word investing. And what does actual investing mean? To me, investing means financing something. You starting up a company, issuing equity, issuing debt, and me giving you actual money. That is real investing. But that is only actually a tiny part of global markets. Equity issuance in the S&P 500, for example, is 0.1%. The number of IPOs every year in most stock markets is less than 1%. But when most of us talk about investing, people on the radio, people on the TV, I've bought shares in this, I've sold shares in that, it's actually trading. The piece of paper has already been issued. It's being traded in the secondary market. For every seller, there's a buyer, and for every buyer, there's a seller. And it goes round and round and round. It makes no difference to the company whatsoever once it's issued those shares, whether you buy it or not. And so when the European Union or Paris Alignment or the UN tells all investors they must sell their coal shares, they're moronic. Everybody can't sell. Imagine everybody in this room is being told to sell. You're the entire market, and you're all being told to sell your coal shares. You can't. You've got to sell them to him. He's got to sell them to you. Someone's got to own them. So it's impossible for everybody to become sustainable in secondary markets. The primary market, sure, that makes a difference. And investors can make a difference in the primary market. If we all withhold our capital from a company, they will hurt. If we fund green renewable companies, that makes a difference. But this round and round and round and round secondary market stuff makes no difference at all. And we know that. We know that every single institutional manager says they're selling their coal shares for the last 2 years. Coal stocks have gone through the roof. Oil stocks have gone through the roof. Every single institutional investor has sold their tobacco shares for the last 10, 15 years. It's one of the best performing stocks and sectors in the world because share prices move on the basis of fundamentals and active investors who look and decide what the fundamental value is. In the short run, somebody selling something may make a difference, but in the long run, it doesn't matter whatsoever. So my argument is always, let's not worry about the secondary market. I'm always being told at HSBC we had to divest. The best way to help the world is to divest our coal shares or to divest our oil stocks. It doesn't make any difference. Sure, HSBC, the bank, may stop financing coal companies. That makes a difference. But leave us asset managers and individuals who own shares in our pension funds, leave that alone. The only way you actually affect companies in the secondary market is through engagement, through voting, through engaging with a company. And actually, you could argue it's immoral to sell your shares because then you can't actually engage with the company. Imagine politics. If the party that you didn't like didn't get into power, you don't rip up your voting card. Now, nobody does that. You want a seat at the table. You want to be able to engage with companies and help them transition or help them change. This chart is simply telling you that actually most of the assets, which are described by the size of the balls, are in these secondary markets: listed equities, government bonds, listed credit. And they are more trading companies than financing companies. And on the trading side, you get your impact through engagement. You don't get it through buying and selling. So if you really want to have an impact as an investor, you want to invest in the types of products that are engaged in the primary market: private equity, venture capital, direct loans, direct credit. Even corporate bonds, to an extent, have influence because companies have to roll them over every so often, and at that point, you have influence over them. But macro hedge funds, listed equities, that sort of stuff, buying and selling has very little impact, and the only way that you can change the world owning secondary market securities is via engagement. And that's why I had one of the largest engagement teams in the world at HSBC, and a lot of asset managers are slowly beginning to realize that the only way that you can affect things through secondary markets is through voting. Now let's think about companies and the impact companies have. Companies, on the other hand, unlike investors, have a huge role to play. massive amounts of impact, not only in what they buy, but how they make them and the energy they consume, the fact that they have control over their employees, and they generate a huge amount of emissions, for example. And even to this day, even in somewhere like America, 2/3 of people work for a firm. So if you care about society and inequality and the number of women on boards and all of that sort of thing, companies play an absolutely crucial role in making the world a better place. There is no doubt about that at all. It makes a huge difference. That said, the listed sector, for example, only accounts for about 25% of all emissions. A lot of companies are owned by governments and that sort of thing. But companies themselves have an absolutely crucial role to play. Now, the problem is, even today, there is no agreed definition of a good company. There is none. The European Union is trying to create one with the EU taxonomy. You've heard about that, trying to measure emissions, trying to measure this and that. But at the moment, there is none. So it is left to silly people like me and other banks to come up with a score. And I'm not talking about input, I'm talking about output. What is a good company? If 10% of your revenues are good, does that make you good? Half? 100? No one knows. What about if the good bit of your company is going up in value? Is that important? Is it the secondary effect? Is it the growth of the good bits? Does the fact that Shell spends €1 billion a year on renewables, does that make it good? Or does the fact that it's an oil company make it bad? Is it if the bad stuff is falling? Maybe that's a good thing. Is it revenues? Is it a percentage of revenues that are green matter? But any investor knows that revenues aren't very important. Why isn't it profits? Why isn't it operating profits? Why isn't it cash flows? Or maybe some people think, you know what, if you pollute, you're bad, and that's the end of the story. Now, this is no game, and this is no intellectual exercise. Every fund that you guys look at in the market when you buy has people like me trying to work out whether the companies in those funds are green or sustainable or not. And we've all come up with a different measure. So you can go in to HSBC or another asset manager and buy an Article 9 fund, which is supposedly as green as they get. Some of them will have Exxon. Some of them, like mine, I decided, you know what, Exxon really shouldn't be in a sustainable fund, it's out. But plenty of people have said, well, they're spending money on renewables, they're doing the right thing, we decide that it's green. And there is no regulation about this at the moment. So it is a very, very difficult area of the ESG debate. My argument is that this is going to get tightened up. It shouldn't be left to investors. Governments and regulators should be all over this. Mums and dads and investors should not be the ones saying that this company is better or greener than another company. We should definitely be the ones in control of ESG as an input, in the same way that analysts analyze companies today and come up with different valuations and come up with different scores. That's fine. But on the output side, it should not be left to us at all. Okay, so I'm finally going to conclude on the grown-up way for a bank to think about ESG, given what I've said, a normal company, and for governments and regulators. So for a bank, given what I've said, let's take the commercial side of the bank that lends money to corporate customers. That is proper financing. So a bank should decide what its priorities are. And as I said last night in my speech, you can't do everything, but once the bank has decided what its priorities are, for example, it wants to reduce the number of coal-fired power plants in the world, it can withdraw funds through its commercial bank. That's absolutely fine. And it can extend money to renewable companies. Absolutely fine again. It can also increase engagement with those clients, and it can help existing clients transition. Tick. On the retail side, what is important? On the retail side, it's all about reputation. Walking the talk, not being caught out doing something that you said that you haven't done. It's about understanding your customers, understanding that millennials care about this stuff more than ever before, And you need to spend a lot of money on PR and marketing. That is very, very important for the retail arm. What about investment banking? Investment bankers often operate in two areas. They operate in the primary market. So again, your priorities should extend to your investment bank. I'm going to give money to you. I'm not going to take money away from you. I'm not going to help you IPO your coal business. I'll help you IPO your renewables business. That makes sense. But for the part of the investment bank that deals with flow and FX and equities and credit, just leave it alone. That is just flow, secondary market stuff. Just ignore it. Asset management, I've already talked about. If you own an asset manager, tell them that they can't invest directly in certain things with their private equity division or their hedge fund division, but leave the active equity guys alone. Leave the bond people alone. Leave the secondary market area alone. Don't tell me that I can't invest in coal stocks with my equity portfolios. It makes no difference. What we should be doing is engaging with coal companies, voting our shares and helping them transition. What about the bosses in corporate and risk? This is about leading from the front. CEOs of banks need to walk the talk, fly less, say what they're going to do and then actually do it and inspire their companies from the top. A big part of working at a bank or any company now is employing people, particularly in this market, and a lot of young people and millennials look to what a bank and a company is doing when they choose where to work. And this culture has to come directly from the top, otherwise it doesn't work. For insurance companies, don't insure bad clients that you don't like. Insure clients that you think are helping in the transition. When you have your big general investment book, though, again, don't worry about underweighting certain sectors and overweighting others. Forget about it. It's a little bit like the asset management division as well. Leave that alone. But where you're directly helping clients, you can extend your ESG beliefs onto them. What about companies then? Companies are slightly different to banks, but only in a few areas. How should banks think about ESG? Laws and regulations, it's coming your way. You're going to have to do it. So if you're going to have to do it, be the best at it. There's no getting away from it. There's nothing you can do. There's no point fighting back. So at least be best in class. And that's about producing data, being very, very open and transparent about various metrics along the ESG scale. Again, you need to set your priorities. When I talk to a lot of CEOs, I say, you can't change everything in the world. Decide what your company does, what you care about, and do that. And when newspapers or charities come after you and say, why don't you care about this? Or why don't you care about inequality? Or why don't you care about mangroves in Brazil? You say, look, I do care about those things, but we've decided that we're going to concentrate on this stuff the most, and we're going to do that well, and we're going to be open about it. You can't do everything and please everybody. Be very careful about greenwashing. Everybody is trying to race into the ESG space quickly. I can tell you, for banks and asset managers, there's going to be a mis-selling crisis. And you know that greenwashing concerns really worry regulators a lot. And you need to be very, very careful. I would advise being conservative always. Don't try and fudge the numbers. Don't try and say something you're not. It's perfectly fine to say, look, ESG is relatively new. We're trying our best. Here is what we've got. We are moving in the right direction. Don't rush and say things that aren't true. And we all know many companies already that are making that mistake. Finally, on investors, flip the argument around. If an investor on the direct side doesn't like you, that matters. You may not get the funding, you may get the funding. But on secondary market, if you're a listed company, if there's anyone here who works for a listed company, don't worry if somebody sells your stock. Someone will buy it. There has to be a buyer, by definition. Worry less about those listed investors and those groups that may sell your shares. It doesn't matter. What will determine your share price is the fundamentals of your business. That's what determines your share price. And disclose as much as you can because it's coming anyway. Collect the data on your emissions. Collect the data on diversity. Start collecting data on pay because they're coming for you and you will have to disclose it. There's no question. So final slide on what government should do. And that reflects what I have said so far. You need to support the EU legislation that you can, make sure that your local laws are adhered to and your security codes, and make sure all of that is tight. All of that has to be tight. And most countries do a pretty good job on this stuff. Second point is a big one. Don't ask companies to solve your political, moral, and ethical problems. We're not voted. No one has voted for a company's CEO. No one has voted for the head of sustainability at HSBC. Moral, ethical, and political decisions should be left to politicians and the people who vote for them. Don't ask the private sector to make moral and ethical judgments. You tell us. We're not elected. It's immoral for us to be making those decisions. We need guidance from our elected officials. Encourage best-in-class disclosure. That's what I've said before. It's coming anyway, and it would be a wonderful thing for a country like Portugal to be leading the way in the amount of information companies can give. The EU will demand a certain amount, but why not go further? And investors will very much appreciate that. Think about climate adaptation as well as mitigation. Prepare for climate change. Too much money is spent on mitigation and not enough about adapting to the effect of climate change. And actually, the amounts involved aren't that large. And finally, growth. None of this stuff around ESG and sustainability can be solved without money. And the most important thing is to make sure your economy is growing, companies are helpful and healthy and profitable, and only when the funds are available can all the problems that we're trying to solve be funded. And so I would never ask a government or a regulator or someone in the finance department to take their eye off the fundamental issue of making sure that economies and companies generate the funds necessary to aid the transition and all the other good things that we want to do in society. If that last bullet point doesn't happen, everything else I've said is completely moot. So I've got 5 minutes left. I'll leave it there. Thank you for your attention. And I'm very happy to take questions either with my buy-side investor hat on, my sell-side analyst hat on, my management consultancy hat on, my journalist hat on. Very happy to take questions. Yes?
Very challenging. And I'll start with a comment on your last slide. I mean, we had to listen to you for 30 minutes to really to hear something that is extremely provocative. We need to grow to be more sustainable. And in fact, you couldn't be more correct. So that's just a comment. Now for a question. Particularly at the beginning of your talk, you were critical of government, paperwork, bureaucracy. And then in the second half of your talk, you said that companies are crucial in the process. Now, we know that certain industries or certain companies have a spotty record, particularly when issues start. The first reaction of industry, of companies, is rejection. Absolutely not. You're wrong. You're a communist. You're a fanatic. But we know that policy is extremely important. I mean, the EU has said by 2035, no petrol engines, no diesel engines. And Carlos Tavares, president of Stellantis, said, oh, that's rather dogmatic. Well, he would, wouldn't he? Don't we need, and that's my question, don't we need policy as much as helpful, enthusiastic companies to solve this?
Yeah, and, you know, policy comes from government, and government's supported by the electorate, and what that policy ultimately is out of companies' hands to a large extent. And companies can only reflect the society and the politics and the policies that they work under. Having said that, companies for hundreds of years have been happy to disclose numbers, accounting numbers. And all I'm saying is that the amount of numbers that are going to be disclosed in future will incorporate a whole bunch of other things along the ESG spectrum. On the bureaucracy side of things, there's a huge amount of bureaucracy around the secondary market as well. And I would say just ignore that. So the net zero asset management initiative, the net zero asset owner initiative, the same for insurance companies, a lot of that red tape is around the trading of shares. And I would just cut all of anything to do with secondary markets, I would just cut in terms of bureaucracy. I would leave it to the primary markets and leave it to companies on what they need to disclose. Investors will want you to disclose it ultimately anyway, and so I think investor demand and government demand will end up being aligned. Now, of course, bureaucracies always grow and they like to fund themselves, and there'll be thousands and thousands of people working in this area, but I think ultimately that will be a good thing. And we'll start off having the wrong metrics, and some of them will work, some of them won't work. But over time, we'll realize the ones that are important, we'll ditch the ones that aren't important, and we'll end up in a better place. At the moment, as somebody who used to analyze companies, disclosure is still extremely poor. If you were to think of E, S, and G, on the S metric, we know almost nothing about S when it comes to companies. We don't know the stress levels. We don't know how many people are sick. We don't know about absenteeism. We don't know about what people get paid. Loads and loads of things around S we know nothing about whatsoever. And I think that companies can disclose a lot more, and it won't harm them. Yes?
Well, thank you for your presentation. I would just like to make a point about your approach to primary markets vis-à-vis secondary markets. You see, if you have a kind of constraint which is dictated by, for example, the largest investment funds in the world for the acquisition of certain type of companies, that will affect, you know, certain fundamental criteria for the valuation of those companies. For example, it will increase the discount rate. It will reduce the multiples for the valuation, the multiples of earnings or the multiples of EBITDA. So in fact, if those fundamental things about the valuation of those companies will take place, then you'll be directly affecting the primary market, because when there's the issuance of debt or issuance of equity, that will be strongly affected. Because everyone, and the consulting companies and the investment banks that are going to advise the issuance of debt or the issuance of equity, they will take a look about what's happening in the secondary market, to give the guidance for such issuance. So that was a point.
No, it's a point a lot of people make. You're absolutely right that it will make a difference when a company wants to raise equity, and it will make a difference when a company wants to raise debt. But in the same way that the rise of ETFs, who again are forced buyers or forced sellers, makes no difference at all to the valuation of companies, in the same way that if Norges Bank decides that it doesn't want to buy a coal company, it will sell in the open market and it will get the prevailing rate in the market. Their traders will put the trade on, and they will try and sell at the prevailing rate. But that price that they get will be determined by active managers who decide on the free cash flow of that company and the future returns. And it must be true. If volumes affected markets, the large markets would be more expensive than small markets. If volumes affected markets, coal company shares would be falling at the moment. They're not. They're reflecting ultimately fundamentals. There's a lot of academic papers on whether the secondary market affects the primary market, as you well know. But it doesn't. It doesn't. And we know that anecdotally, but absolutely right. In the primary market, if a company has to come back and Norges Bank says, we're not investing in you because either our discount rate is higher or we're just not going to, the cost of that company coming back to the market will be higher. But my point is that the primary market relative to the secondary market is infinitesimally small. And in fact, most markets today, free cash flow of companies is larger than their capex. Most companies don't need to go back to the market. We like to think in finance that we're much more important than we are. Most companies now are self-financing in the world. But you are absolutely right. For a forced seller in the primary market, there'll be a premium. Absolutely.
Thank you very much for your very interesting presentation. One question still along the same line as the last one on the differences, the different approach to primary and secondary markets. You said rightly that engagement matters. It's probably what matters the most. But for investors or whatever you want to call them, to be available to engage with those companies, they have to hold the shares. And so, and here it is neutral if whether they have acquired, bought shares on the primary or the secondary market. And also in this respect, I think that the movement, the trading in secondary market is not completely neutral with respect to the ESG decisions and the influence and impact in the companies.
Yeah, so if you put your input hat on, ESG does affect the share price performance of a company, right? Weather has always affected retailers, bad culture in the S affects, poor governance. I'm not saying that ESG as an input doesn't have an effect. I'm saying that the underweighting or the overweighting in the secondary market doesn't really have an effect. But you're absolutely right about holding it, and this is about my moral point, and I've written about this in the FT. You could argue, and you should argue, I think, if you really want to make a difference, people who care about ESG should own the bad companies. You should deliberately own the bad companies so you have a seat at the table and you can vote your shares. You should be doing the complete opposite of what the entire industry is doing. You should own them, not divest them.
Very interesting, thank you very much. It's thought that your presentation was very much centered in Europe. Is this the same view that the US has? Is this affecting in any way the sustainability of European companies to really work and have their business? Because regulations can be different, the cost of doing business can be different. What is your opinion there?
I think it's a very important point. Clearly, I mean, you saw from my first slide that ESG assets are growing in the US, but clearly there's a backlash in the US which is much more developed. It differs from state to state depending on whether it's conservative or Democrat. There are laws now in place that are preventing certain state pension funds investing with asset managers that invest via ESG. And there are a number of companies being set up, asset management companies like Thrive Asset Management, that say, you know what? Companies have a fiduciary duty to increase shareholder returns. They do not have a political imperative to change the world. I want my companies to make me money, and that's how we are going to run our shares. And that's getting quite a bit of, and I know those guys, that's getting quite a lot of headway. I think there is a real risk in Europe if we smother companies and asset managers with too much ESG regulation, that the continued dominance of the US over European firms, which is now 20, 25 years old, and there's only 10 European firms in the top 100, all of that sort of stuff will begin to play a real effect. But there is an ESG movement in the US, but it's polar in the same way that the politics is. So it's become caught up in the culture wars. Red, blue, sustainable, non-sustainable, Trump, not Trump. The whole thing is, and that's why my speech went viral. My speech wasn't very interesting. It was the fact that it got caught up in this left-right, Trump, anti-Trump debate that's really, really powerful in the US. And that would be sad. That would be sad if ESG got caught up in that culture war, because it's very important, ESG. But it needs to be done the right way and not be all-consuming.
Thank you very much, Stuart, for this.
Thank you very much. And thank you very much for having me, everybody.